Namaste dosto and welcome back to my channel. Finding investment options that give you assured returns after factoring in inflation and taxes can be tricky in India. In this video, I will explore popular assured return investment avenues in India like fixed deposits, savings accounts, PPF, Sukanya Samriddhi, Senior Citizen Savings Scheme, Post Office Monthly Income Scheme, RBI Bonds, etc. We will do an in-depth analysis of post-tax, post-inflation returns on these options so you know exactly how much you will earn. I will also share tips on choosing the right investment mix and laddering deposits to maximize assured returns. This video will equip you with the knowledge to invest wisely in fixed return options that beat inflation and taxes. So let's get started. 1. Fixed deposits. First up, the fixed deposit, one of the most popular assured return investment products in India. FDs are offered by banks and NBFCs and provide guaranteed returns for a specified tenure. The current interest rates on FDs range from about 5% to 6.5% for tenures from 1 to 5 years. These rates vary slightly across institutions. The returns from FDs are subject to income tax as per your tax slab. So for effective post-tax returns, you have to factor in taxation. For example, if you are in the 30% tax bracket and invest 1 lakh rupees in an FD offering 6% interest, your interest for 1 year will be Rs. 6,000. On this, you will pay 30% tax, which is Rs. 1,800. So your post-tax return is Rs. 4,200 or 4.2%. The current inflation rate in India is around 6% on average. So the real return from this FD is negative after adjusting for inflation. To earn positive assured returns from FDs after tax and inflation, it is advisable to invest for longer tenures of 5 years or more. The longer tenures offer interest rates up to 6.5% or more. Combining the higher interest rates with long tenure and the benefit of indexation on taxes makes FDs a decent assured returns option. I'd recommended laddering your deposits, spreading them across different maturity tenures. This provides stability of returns over the long term. 2. Savings accounts. Another popular option is the savings account. All banks offer these, with average interest rates of about 4% now. Just like FDs, savings account interest is fully taxable. At 30% tax on Rs. 4,000 interest on 1 lakh rupees deposit, your post-tax return is 2.8%. So after tax and inflation, the returns are negative. Savings accounts are hence better used for liquidity needs rather than long-term assured returns. 3. The Post Office Monthly Income Scheme. This scheme offered by India Post provides fixed returns through monthly payouts. The current interest rate is 6.6% per annum, paid out monthly. For senior citizens, it is 6.7%. The tenure is 5 years. Premature withdrawals are allowed after 1 year, with discounted interest payouts. Taxation of returns follows income tax rules. Considering 30% tax bracket, the post-tax return is 4.62% for general investors. So this scheme does provide positive real returns for investors after factoring taxes and inflation. A key benefit is the regular monthly payout structure. 4. Public Provident Fund. The PPF is one of the most popular long-term tax-saving instruments in India. It comes with guaranteed returns fully backed by the government. The current interest rate is 7.1% per annum. You can invest up to Rs. 1.5 lakh per year. The minimum tenure is 15 years. The best part about PPF is that the returns are completely tax-free. So the effective post-tax yield is 7.1% itself. This is higher than the prevailing inflation rate. So the PPF provides assured, inflation-beating returns. The compulsory long tenure of 15 years also matches the requirements of long-term financial planning. 5. The Sukanya Samriddhi Scheme. This savings scheme was launched by the government to support parents in planning finances for their girl child's education and wedding. The Sukanya Samriddhi account can be opened anytime after a girl child is born, up to age 10. The current interest rate is 7.6% per annum. Tax treatment is the same as PPF, completely tax-free. The tenure is 21 years, or alternatively till the girl turns 18. Premature withdrawals are allowed after the girl turns 18. At 7.6% tax-free returns, this assured return scheme also beats inflation handily. The focus is long-term savings for your daughter's future. 6. Senior Citizen Savings Scheme. The SCSS is a must-have in any retirement investment portfolio. It provides assured returns with quarterly payouts specifically for senior citizens. The current interest rate is 7.4% per annum. Only citizens above 60 years of age can invest. The maximum allowed investment is 15 lakh rupees per individual. The tenure is 5 years, with an option to extend by 3 more years. SCSS offers tax benefits under Section 80C up to Rs. 1.5 lakh invested. So effective post-tax returns will be over 6% for most senior citizens. After indexation, long-term capital gains tax on the maturity proceeds is also zero. So, SCSS effectively provides inflation-beating assured returns for retired investors, making it a crucial fixed income instrument. 7. RBI taxable bonds. RBI releases special government bonds from time to time with varying interest rates. For example, the 7.75% savings bond scheme was open from January 2018 to December 2018. These bonds offer guaranteed returns with no default risk since they are backed by the Indian government. The taxation will depend on each bond scheme structure. Based on the tax rate applicable, you can calculate post-tax returns and compare versus inflation to assess real yield. RBI bonds, when available, are attractive fixed income options. However, the interest rates are usually aligned to prevailing bank FD rates. 8. Post office time deposit. A good alternative to bank FDs are post office time deposits offered through India Post. These offer guaranteed returns like bank FDs. The latest interest rates are 5.5% for 1-3 years and 6.7% for 5 years. Taxation is like FD's income tax as per your slab. The post office deposits have the benefit of sovereign guarantee of returns. This makes them completely safe. By laddering deposits across different tenures, you can earn inflation-beating assured returns. 9. Combining small savings schemes. A well-planned combination of the PPF, SCSS, Sukanya scheme, MIS and post office deposits can create a diversified fixed income portfolio. When used together in a strategic asset allocation, they can collectively beat inflation and taxes to provide true assured returns. The advantage of recurring deposits. Recurring deposits allow disciplined investing to build a large corpus over time. Banks and post offices offer RDs with guaranteed returns. Interest rates vary from 5.5% to 6%. By making monthly contributions to an RD, your money grows through compounding. This creates a sizable corpus for goals like retirement or child education. RDs provide the benefits of habit formation and disciplined investing. When the matured corpus is reinvested, it earns even higher assured returns. 10. Voluntary Provident Fund. Employees of organizations with VPF can increase their retirement savings beyond PF deductions. The returns on VPF equals the prevailing employees' provident fund interest rate, now 8.1% per annum. The maturity corpus and withdrawals are tax-free under EEE regime, making it very attractive for retirement planning. By making voluntary contributions to VPFs, salaried employees can earn inflation-beating assured returns. These assured returns deposits are safe since chances of a society defaulting are remote. They offer positive real returns after taxes. Tips for maximizing assured investment returns. Here are some tips to maximize assured post-tax, post-inflation returns on your investments. Compare interest rates across institutions before investing. Prefer options that offer tax benefits like PPF, Sukanya, SCSS, VPF, etc. Ladder maturity dates across years to benefit from compounding. Reinvest interest payouts and maturity proceeds for higher returns. Opt for longer tenure deposits of 5 years or more to get highest rates. Maintain an adequate emergency corpus in liquid funds before locking into tenure deposits. Consider inflation index bonds that adjust returns to inflation. Never chase very high assured returns blindly without checking issuer credibility. Closing thoughts. So, in summary, by using a tailored combination of assured return investment schemes offered in India and remaining invested for long tenures, retail investors can beat inflation and taxes. The PPF, RDs, SCSS, Sukanya, post office and corporate deposits, RBI bonds, endowment plans, etc. are all good options providing stable inflation-adjusted returns. Maintain prudent asset allocation, ladder maturity dates, and reinvest proceeds for compounded earnings. I hope this detailed video has provided you a deep understanding of constructing an assured return-focused investment portfolio in India. Which of these options are you considering investing in? Let me know in the comments. If you learned something new today, please like this video and also subscribe to my channel. I'll continue bringing you more useful and in-depth personal finance content. Stay tuned and invest wisely, my friends.